So it's the end of the week and we are back with a brand new episode of Smart Money. Now in today's episode, we will discuss one crucial element while tracking equity markets. As we know, many things are important to understand equity markets, whether it's earnings, liquidity or even government policy. But one crucial indicator to track equity market movements is the currency. And now we're going to discuss just that. The rupee has in fact been under pressure for a while now. The last couple of weeks, the rupee is now veering towards that 83 to the dollar mark. Our expert today is Manish Gunwani. He's the head of equities at Bandhan AMC. Of course, in his prior capacity, he has been with ICICI Pru, has been with Nippon as well. Manish, thank you so much for being here with us on CNBC-TV18. Let's start with the basics, right? Why is the currency important for stock market investors, especially in a setup like today?
Well, Sonia, there are multiple reasons why currency is important. The most direct one for a stock market investor is that an important constituency of the stock market, the Indian stock market, are foreign funds, right? Because they own 18-20% of the equity markets. Whenever foreign flows are strong, we see market going up and vice versa. Now, for a foreign fund, obviously the return is a mix of the local currency return, that is the stock market return in rupee terms, and the currency versus USD, let's say, because most of the returns are in USD. Now, interestingly, when you look at emerging markets, the thing is, most emerging markets, the local currency returns actually beat inflation by a significant margin. But the problem is, in dollar terms, you will see that the returns are very different. So if I take, let's say, last 10 years, you take emerging markets like South Africa or Brazil versus India or Indonesia. Now, in dollar terms, you will see that the returns are very different. It's not because the local currency returns are very different. So India has broadly done about 11% in last 10 years. In dollar terms, about 7.5%. South Africa, Brazil are not very different in local currency. It's about 7-8%. But virtually 1 or 2% in dollar terms. So you can imagine that for a foreign investor, why dollar currency movements are so important, because virtually the difference in dollar returns is coming more from currency or as much from currency as the local currency returns.
Okay, in fact, we had a very helpful chart that came up on our screen as well. It'll be with you in a minute about the currency returns that you have in dollar terms versus the rupee. And you said that, 11.6% in the local currency terms is what we've seen in the last 10 years, right?
Yeah.
And look at the others. So just to explain, because a large part of our community that our viewers are retail local investors.
Right.
So for them, I understood from a foreign investor standpoint, but from a local investor standpoint, how does it matter?
Because eventually you have to see who's buying and selling the market. If you're a serious investor, if I am sitting in India, I am a local investor, I am looking at local returns. But eventually, if 18-20% of the market is owned by foreigners, I have to be more positive on the stock market when rupee looks strong, and I have to be negative on the market when rupee looks weak, right? So even as a domestic investor, for me, the outlook on rupee should be very important.
And in that context, how are the currency swings linked to liquidity, to rates? And, just to try and understand, because eventually it boils down to stocks and sectors, which are the sectors that get impacted the most, say when the rupee is now, almost at 83?
Now, that's an important point you made, that one is the stock market, why the currency is important. But probably the bigger impact is also on the economy as such, because from a monetary policy perspective, how do you conduct the monetary policy? The currency movement is very important. Now, in terms of inflation, for example, typically for an emerging market like India, a lot of the inflation is commodity linked, which is import parity price linked. And if rupee appreciates, it is easier to control inflation and vice versa. Also, in terms of liquidity, how is liquidity generated in the financial system? The most primary liquidity is the central bank balance sheet. And if you see RBI's balance sheet, the $600 billion of forex reserve it holds, that is a very big part of the central bank balance sheet, right? So if you feel that the Indian currency is well placed and you're going to get foreign flows, obviously it's easier for the central bank to coordinate its monetary policy than if you're under a lot of pressure like 2013, where we were seeing a lot of capital flow out. So both in terms of liquidity and rates also, the currency outlook is very, very important.
Okay, and in that context, how do you approach sectors? So, a lot of sectors have that big exposure, right? Whether it's export-oriented sectors, whether it's technology. At a time when the currency is depreciating compared to the US dollar, what's the outlook now on individual sectors?
So, India is a market where actually, in terms of rupee depreciation, that helps corporate earnings, because roughly 35 to 40% of Nifty earnings actually benefit when rupee depreciates, because you have fairly large sectors like IT, pharma, refining, metals, which benefit when rupee depreciates. But when rupee appreciates, there are not too many sectors which benefit directly. But obviously your consumer goods, etc., they benefit from the fact that the raw material cost become more manageable.
So let's talk once again about the currency, right? What is the long-term behavior of the currency indicating to you from an equity market standpoint?
So if you see how does the currency behave long-term, typically if you see very long-term, if I take 20, 30 years, it is broadly shown by data that currencies follow inflation. So if I take India versus US, right, the INR versus the USD, if you take last 30 years, broadly the gap in inflation between India and US is about 4%. And rupees depreciated about 3.3%. So, which basically means that the currency has followed inflation. Just to give you a very popular or liquid pair, which is USD versus pound, again on last 30-year basis, the USD has appreciated roughly about 1% against the pound in 30 years, because the inflation differential has been 1%, roughly. So the point is, very long term, it follows inflation, which is why a widely used metric to track currency is the real effective exchange rate. It is not a single number, because you can choose, it is against a basket of currencies. So you can choose which currencies are you measuring it against and what are the weights. But it's a good number to look, because very long term for stable economies, the real effective exchange rate, or REER as we call it, should be broadly stable.
So on that note, how does the REER work in terms of currency movement? So from here on, if I'm, I've just started tracking the currency market and I want to understand more. In terms of the currency movement, how does the REER work?
So REER, in terms of long term, it should be stable. But what does tend to happen, especially in emerging markets, is that you will have structural shifts in your terms of trade. By terms of trade, I mean, how does your big export items behave versus how does your big import items behave? So for India, for example, in 2014, oil fell from 100 to 40 and stayed at 40, 50, 60 for a long period of time. So if you see India's REER in 2014, it appreciated and has stayed at a higher level post that, because your biggest import item has basically fallen in value.
Okay. Well, all of this, of course, has implications in the stock market in the here and the now as well. I want to talk about that, but I need to take a short commercial break, so don't go anywhere. We'll come back in just a bit, and since Manish is a market veteran, we'll also ask him about his views on the stock markets and how to approach it after what has been a really volatile time in the last couple of weeks. Stay with us.